Hi students, Professor Orenberg here, and welcome to our series on organizational choices. This will be a series of videos covering which type of business association to form and why. And we're going to break this apart into a series of smaller videos to make it a little easier to remember all of the details that are involved in the study of business associations' organizational choices. So let's get started. This series is going to proceed with 6 videos. First, we're going to introduce the process of selecting a business entity by reviewing 7 issues that are going to come up time and time again when deciding what entity to choose. We're then going to discuss the 4 major types of organizational choices: general partnerships, limited partnerships, C corporations, and limited liability companies, in the context of those 7 issues, forming a matrix of effectively 4 entity choices by 7 issues. And then in our 6th video, we're going to summarize everything by briefly noting some alternative organizational choices that can be used for professional groups, and then summarizing the 7 issues across this matrix of 4 types of organizational choices. And in that process, you will learn the differences between the 4 major organizational choices and when to select one or the other for basic business planning purposes. The general partnership business form is cheap, easy, and time-tested, but it has unlimited liability for the partners in the general partnership. There are actually a number of types of partnerships, but we begin with the general partnership because it is the simplest and it is the easiest to form. Plus, it forms the foundation in terms of partnership rules, and we can then look at the specialty forms as a spin-off of this general entity choice. So what is a general partnership? It's a voluntary association of 2 or more persons to carry on as co-owners a business for profit. The default rule is that unless otherwise agreed, all partners participate fully in management and share equally in profits and losses, although their contributions can vary. The most basic type of partnership, again, does not shield the partners from liability. The partnership law in most states is the Uniform Partnership Act, or the Revised Uniform Partnership Act, and really it's the Revised Act which is much more commonplace, as you can see by the chart on the screen. It's virtually universal. Almost every state in America has adopted a version of the 1997 Revised Uniform Partnership Act, making partnerships very similar in all 50 states. So in order to understand partnerships, the first thing to note is that, like all business entities, they are creatures of state law, but it's not super difficult to learn because really there aren't a ton of different varieties of partnership statutes, and we'll cover the main difference in this brief talk. But as you can see, once again, most states have enacted the same partnership law. Under the partnership laws enacted by most states, the Revised Uniform Partnership Act of 97, a partnership is defined as an association of 2 or more persons to carry on as business, as co-owners of business for profit. And that means that we can create a business without any legal formalities. Simply engaging in business activity is enough for 2 people to form a partnership. That's a blessing and a curse. On the one hand, it's cheap and easy. On the other hand, partnerships create liability for the partners, and therefore these liabilities can happen incidentally without deliberateness, and that's something to watch out for. So how is a partnership formed? It's formed by agreement. No filing is required, and this means it can be created inadvertently. So in terms of formation, it's very easy to form a general partnership, making it appealing in this sense. However, if one forms a general partnership by default, simply by agreement or by action, inadvertently, of course, there's not going to be a written agreement discussing how the partners are to share liabilities and profits, and that's a problem because now we're going to be stuck with a default regime that the partners may not be aware of. So while we don't need a partnership agreement, the lack of one can create a lot of uncertainty and can create some issues for the partners and increase their liability even more. I can't emphasize this enough. The big issue with general partnerships is that they're formed inadvertently, whether or not the person intends to form them. Note that Simply agreeing among partners to carry on as co-owners of business for profit is enough to create a partnership. And that means that we can have partnership liability without filing any forms or any intention to. Who is a person? Well, a person can include an individual, of course, but also a corporation or another partnership can form a partnership. What does it mean then to carry on as co-owners a business? According to the Revised Uniform Partnership Act, Section 202, Comment 1, ownership involves the power of ultimate control. To state that co-owners of a business, to state that partners are co-owners in a business is to state that they each have the power of ultimate control. And a business is defined very loosely as a series of acts directed toward an end, usually a profitable end, but it's not necessary for the definition. The RUPA illustrates the principle as follows. A, quote-unquote, operates a business and has hired B as a receptionist. Even though B is given a share of the profits as a wage increase, they are not co-owners. Why? Because A is an employer and B is the employee. Even if they call themselves partners, that doesn't make them partners, because the receptionist, unless she's unusual in her job responsibilities, does not have the power of ultimate control. And that's what it takes to be a partner in a partnership. What does this have to be for profit to be a partnership? Note that a business is any directed series of acts, any series of acts directed toward an end. But a partnership has to be for profit. Partnership is about ownership in a profit-making venture, and ownership is defined in terms of profit and liability. Not-for-profits, by definition, don't have owners. So if one is engaging in charitable operations that's not for profit, that will not form a partnership. Key point, again, partnerships can be formed unintentionally. Whenever people engage in business together, they may inadvertently form a partnership unless they have created some alternative structure. That's the key thing to look out for. The reason we care about partners forming a partnership together is that once they're partners, they're liable for each other. Partners have personal liability for the debts and torts of the partnership. And they also have joint and several liability with the ability to indemnify each other for costs that they bore on behalf of the partnership. So that means that if one partner commits a wrongful act or omission while acting for the partnership, the rest are responsible. If the shop manager of the Three Brothers Motor Partnership decides to make a bad investment and purchases 1,000 extra mufflers, well, the other two brothers will have to pay the bill because they are liable for what the partner does while acting for the partnership. Now note that this is an agency concept. We'd have to define what's in the scope of the partnership, but we can return to our agency conversation for detail on that. So we see that the partners have unlimited liability for the general operations of the business and potentially for the harms the business causes. So one should be careful about forming a partnership because it engenders liability. How are partnerships governed? In general, one partner gets one vote, no matter how much they contributed. So if one partner contributed $10 and the other $1 million, without an agreement that says otherwise, they both have equal participation rights, one partner, one vote. And that means that if there are only two partners, they may deadlock. One may say yes, the other says no. And what happens if there's an impasse? If there's an impasse and the business can't move forward, it may have to be dissolved and wound up. So it may be that because the control has not been allocated intelligently, because there's not a deadlock provision, the partnership may fail to function and has to be dissolved. That's the main issue with partnership governance. Again, the rule is that one partner, one vote. We'll see later that one share or $1 may equal one vote, and that's not the case here. Just like partners generally have equal votes no matter how much they contributed, they also tend to get equal shares in profit and losses unless there is an agreement to the contrary. So financial rights in a partnership, like control rights, are equal, meaning that each partner receives an equal share of the distributions, and each may be responsible for an equal share of any losses. There is an exception to this in some states, If a partner only contributes skill and labor and doesn't contribute any thing of value, that may produce a different outcome. The partner who doesn't produce anything of value, who doesn't contribute any money, who is only adding labor and skills, may not be liable for any additional losses. It's sort of deemed inequitable to demand that the partner who couldn't afford to contribute in the first place would be required to make a capital contribution when the business is going poorly. So in general, the rule is that if one of the partners does not contribute any capital, but only labor and skill, the other partners cannot force that partner to share in the losses. But once that partner does make a capital contribution, is able to contribute in a capital fashion, that partner is going to be equally liable for profits and losses both. In terms of the ending of a partnership or the continuity, there is a difference here between the Uniform Partnership Act and the Revised Uniform Partnership Act. In the Uniform Partnership Act, which is in a very minority of jurisdictions at this point, not very common at all, there was a rule that effectively the partnership was seen to be an aggregate of the partners and not its own entity. So any withdrawal of any partner would effectively destroy the aggregation. If you had three partners in the partnership and one withdrew, clearly that aggregation no longer exists in the same way. And so withdrawal would lead to a dissolution. The partnership would cease to exist and reform. Conceptually, RUPA works a little differently. Withdrawal leads to the option to buy out the additional partner, and this applies what we call the entity theory of partnership, that the partnership has a status, a nature that extends beyond the lifetime of the partners themselves. And so under the Revised Uniform Partnership Act, the disassociation of a partner does not necessarily cause a winding up of the business of the partnership. The remaining parties can instead purchase the departing partner's interests and maintain the business as a going concern. Partnerships are not designed to be very liquid. It's very difficult to sell one's control rights. Remember that partners have joint and several liability for each other, so it's not surprising that a partner can't simply give his shares away to his son or daughter and allow that son or daughter to make partnership decisions that would bind the others. Control rights are only transferable with consent of the partnership, again, because you need to be careful with who you pick for your partners. Financial rights, on the other hand, are generally freely transferable. There can be restrictions placed on these, but you could have your children inherit your share of partnership profits, but they won't be able to participate in the governance of the partnership without the consent of the other partners. So partnership interests are partly liquid. We might think that the financial interests are more liquid than the control rights. The control rights are generally bound up in a given individual or specific person. Finally, mergers between general partnerships are easy. Simply combine the assets by agreement. Couldn't be much easier, so partnerships can get very large without any filing of any sort. Things get more technical when you need to merge between different forms. That's a story for another day. But mergers between partnerships are just as easy as forming them. They can be simply formed by agreement. So even an oral agreement is enough to merge a partnership. So in summary, partnerships are really affordable, easy to set up, and they serve certain purposes quite well. But they have unlimited liability for all of the partners. And again, those partners have joint and several liability with each other. So one has to be very careful with who one partners with, because otherwise one can get stuck with a pretty big partnership bill. That said, what you get for all that is a lack of formality and an ease of use that may be handy in certain cases. Up next, we're going to talk about limited partnerships and identify how those function in comparison to general partnerships.